I firmly believe that all of these technologies are just going to be an accelerant. The state of the art as it relates to Sora allows you to create these really small snippets of video. And the technology is amazing in that it now understands physics, it understands interactions.
That was Adobe CEO on CNBC yesterday speaking about the AI boom. Joining us right now to talk tech and specifically stocks that he likes and doesn't like in AI. Eric Lynch, Managing Director at Scharf Investments. Good morning to you. What is your sense of Adobe, and what companies do you like and what don't you, given that it seems to be an all-in situation right now where there doesn't seem to be a lot of differentiation in terms of how people seem to be thinking about AI?
Yeah, good to be here, Andrew. Thank you. So I think we're at a kind of where's the beef moment for AI, where all the promise needs to be delivered this year. If you look at investors' reactions to several AI kind of stories in the past week, Broadcom, Marvell Technology, Oracle on Monday, and most recently with Adobe yesterday, what you're seeing is a reaction to slower growth than expected. Just to spit some facts to you, revenue growth for the S&P IT sector for 2023 was only 2%. It trailed the S&P's 5%. And so if you take out also NVIDIA's earnings estimates, which are obviously blowing it away from Q1 estimates, the IT sector's earnings growth year over year for Q1 falls from 19 to 6. So now that interest rates reductions are really off the table for the immediate future anyway, it looks like, given PPI, CPI, jobs prints, I think investors are showing a much more discerning orientation to these names. Adobe's a great company. It's had a good quarter, 12% revenue growth, 18% profit growth last night. But the issue, Andrew, is that the stock's up 80% year over year. And for all the exciting things like Firefly, this AI generative applications that they're implementing into the suite, they didn't up their guidance. And it's really not having a measurable additive imprint on the run rate. This is a business that was growing 20% year-over-year revenues from 16 to 21.
So who do you think becomes a winner? You know, we keep talking about how this is going to revolutionize the world, and I think it will in many ways. I just don't know if it all redounds to some of these companies or becomes a feature, if you will, of all of these products.
Yeah, well, I think the first derivative, obviously, are the chip makers and the hyperscalers, which we've seen that in the stock prices, NVIDIA, Microsoft, AWS, and most recently Oracle. Oracle is really guiding for 50% infrastructure cloud growth going forward, because its use case was really generative AI that it needed for its superior tech stack. So these names are all benefiting. It's the second and third derivative stories, which you mentioned, which, technology is always a competitive game. And there's this probably assumption that's not correct, that the new technology is just going to be additive. Oftentimes it just cannibalizes the existing. And that's why IT spend really year over year isn't up. And that's why Marvell and Broadcom didn't really show a lot of growth at the aggregate level, even though AI is growing nicely. So I think what investors need to do is look for businesses where the AI imprint is really going to materially grow earnings and revenues going forward, and not just be kind of a story that's cannibalizing the other tech spend.